Adults. Have you ever noticed how the biggest shifts in the financial world often happen quietly, long before they become headline news? By the time most people recognize a major trend, institutions, governments, and experienced investors have already spent years adapting to it. Today, there is a growing debate taking place beneath the surface of the global economy. It is a discussion about debt, currencies, inflation, interest rates, and the future purchasing power of money. While many people remain focused on daily market movements, some analysts believe a much larger transformation may already be underway. The question is not whether markets will experience ups and downs. Adults. That has always been true. The real question is whether the financial system is entering a new era that could change the way investors think about preserving wealth for years to come. Welcome back to the channel. If you enjoyed content like this, please like, subscribe, and turn on notifications to understand why this conversation has become so important. We need to step back and look at the bigger picture. Over the last several decades, the global economy benefited from powerful forces that supported growth. Technology improved productivity. International trade expanded. Inflation remained relatively contained for long periods, and interest rates generally trended lower. Investors became accustomed to a world where financial assets often performed well. Central banks had room to support markets during periods of stress, and government borrowing costs remained manageable. That environment shaped an entire generation of investment thinking. Many strategies that worked exceptionally well during those years were built on assumptions that seemed almost permanent. Economic growth would continue. Government bonds would remain reliable. Inflation would stay under control, financial markets would recover from downturns, and while temporary disruptions would occur, the broader system would remain stable. But history shows that no economic era lasts forever. Every major financial cycle eventually reaches a point where old assumptions begin to face new challenges. Conditions change, demographics evolve, debt accumulates, priorities shift. New risks emerge while old solutions become less effective. The transition from one era to another rarely happens overnight. Instead, it unfolds gradually through a series of developments that appear disconnected at first but later reveal a larger pattern. One of the most significant factors influencing today's financial landscape is the enormous amount of debt that exists throughout the global economy. Governments, corporations, and households have all relied on borrowing to varying degrees. Debt itself is not necessarily a problem. In many cases, it supports productive investment, economic expansion, infrastructure development, innovation, and improved living standards. The challenge arises when debt grows faster than the underlying economy. Imagine a family whose income rises steadily over time. Taking on a reasonable mortgage or business loan may be manageable because future earnings help support those obligations. However, if borrowing continues increasing while income growth slows, financial pressure eventually begins to build. The same principle applies on a national scale. Countries can manage significant debt levels if economic growth remains strong and borrowing costs stay relatively low. But when debt expands faster than growth, governments face increasingly difficult decisions. They must determine how to balance spending priorities, manage deficits, support economic activity, and maintain investor confidence. These challenges become even more important when interest rates rise. For years, low interest rates made borrowing relatively affordable. Governments could issue debt at historically low costs, reducing the immediate burden of servicing obligations. However, when rates move higher, refinancing existing debt becomes more expensive. Interest payments consume a larger portion of budgets. Resources that might otherwise support infrastructure, education, healthcare, or other priorities are redirected toward debt service. This creates a difficult balancing act. Policymakers want to support economic growth, but they must also maintain fiscal sustainability. They want to control inflation, but they also want to avoid unnecessarily slowing the economy. They want stable financial markets, yet they must respond to changing economic realities. Investors pay close attention to these dynamics because they influence nearly every major asset class. One of the most important relationships in finance involves government bonds. Government debt markets are often viewed as the foundation of the broader financial system. Bond yields influence borrowing costs throughout the economy, affecting mortgages, corporate loans, consumer credit, and investment decisions. Traditionally, when investors viewed a country's finances as stable, government bonds were considered relatively safe. Demand remained strong, borrowing costs stayed manageable, and confidence in the financial system was reinforced. However, perceptions can change. Markets are forward-looking. Investors are constantly evaluating future risks and opportunities. They are not merely interested in current conditions. They want to understand what might happen next year, 5 years from now, or even a decade into the future. When debt levels rise significantly, investors naturally begin asking questions. How sustainable is the current trajectory? Can economic growth keep pace with obligations? What happens if interest rates remain elevated? How will governments respond if financial pressures increase? These questions do not necessarily indicate an impending crisis. Rather, they reflect the normal process through which markets assess risk. Throughout history, confidence has played a central role in financial systems. Confidence encourages investment, supports economic activity, and helps maintain stability. When confidence is strong, investors are generally willing to lend money at lower rates. When confidence weakens, they may demand higher compensation for perceived risks. This is one reason why bond markets receive so much attention from economists and investors. Bond yields are more than just numbers on a screen. They often reflect collective judgments about inflation expectations, growth prospects, fiscal policy, and future economic conditions. At the same time, currencies add another layer of complexity. Currencies are not merely pieces of paper or digital entries in bank accounts. They represent trust in an economy, its institutions, and its future prospects. Exchange rates fluctuate for many reasons, including interest rate differences, trade flows, capital movements, and investor sentiment. Under normal circumstances, higher interest rates can make a currency more attractive because investors receive greater returns on assets denominated in that currency. But financial markets do not always follow simple textbook relationships. Sometimes investors become concerned about the reasons rates are rising. If yields increase because economic growth is strong, markets may respond positively. But if yields rise because investors demand additional compensation for growing fiscal concerns, the implications can be very different. This distinction is crucial. The same market movement can carry entirely different meanings depending on the underlying cause. As analysts examine current conditions around the world, many are paying attention to unusual divergences between bond markets and currency markets. Relationships that appeared stable for years have started behaving differently. While one unusual data point means very little, persistent changes in long-standing patterns often attract attention. Financial history teaches us that major shifts frequently begin with subtle signals. Before large economic transitions become obvious, small inconsistencies often appear. Market relationships weaken. Traditional indicators send mixed messages. Investors notice developments that do not fit established models. Eventually, enough evidence accumulates to suggest that something larger may be changing. Another factor shaping today's environment is inflation. Inflation is sometimes misunderstood as simply rising prices. In reality, it reflects changes in purchasing power. When inflation accelerates, money buys fewer goods and services over time. This can affect household budgets, business planning, investment returns, and government finances. Moderate inflation is generally considered manageable within a growing economy. Problems arise when inflation becomes persistently elevated or unpredictable. Uncertainty creates challenges. Businesses struggle to forecast costs. Consumers become more cautious. Investors reassess risk. Policymakers face difficult trade-offs. One of the most fascinating aspects of the current debate is that different economic scenarios may lead investors toward similar conclusions. Consider a period of weak growth and falling prices. In that environment, concerns may center on debt burdens, credit risks, and financial stability. Now consider a period of higher inflation and declining purchasing power. Here, concerns focus on preserving wealth and maintaining real returns. These scenarios appear very different, yet both can encourage investors to seek assets that are perceived as stores of value. This explains why discussions about debt and monetary policy often lead to conversations about precious metals. For thousands of years, civilizations across different regions and eras have viewed certain tangible assets as stores of wealth. Long before modern financial systems existed, people sought ways to preserve purchasing power across generations. Today's financial world is far more sophisticated than ancient economies, but some fundamental principles remain surprisingly relevant. Investors still care about preserving value. They still seek diversification. They still want protection against uncertainty. And they still recognize that no single asset performs best under every possible circumstance. This is why portfolio construction remains so important. The goal is not to predict the future perfectly. No investor, institution, or economist can consistently forecast every major development. Instead, successful investing often involves preparing for multiple outcomes. Some assets perform well during periods of economic expansion. Others may provide resilience during inflationary environments. Some benefit from technological innovation. Others serve as defensive holdings during uncertainty. A balanced approach acknowledges that the future is inherently unpredictable. Another important consideration is demographics. Many developed economies are experiencing aging populations and slower labor force growth. These trends can influence economic performance, spending, healthcare costs, retirement systems, and productivity. Demographic changes occur gradually, which makes them easy to overlook. Yet their long-term impact can be profound. As populations age, governments often face increasing financial obligations. Pension programs, healthcare systems, and social support networks require funding. At the same time, slower workforce growth can reduce the pace of economic expansion. This does not mean growth becomes impossible. Innovation, automation, and productivity improvements can offset demographic challenges. However, these trends add another layer of complexity to long-term fiscal planning. Technology represents a powerful counterbalance. Throughout history, technological advancements have repeatedly transformed economies. Innovations improve efficiency, reduce costs, create new industries, and increase productivity. Artificial intelligence, automation, advanced manufacturing, biotechnology, and digital infrastructure may generate substantial economic benefits in coming decades. Optimists argue that these developments could help address many of today's challenges. Higher productivity could support stronger growth. Stronger growth could improve fiscal sustainability. Improved efficiency could help manage inflationary pressures. New industries could create economic opportunities. These possibilities highlight an important point. The future is rarely defined by a single trend. Economic outcomes emerge from the interaction of multiple forces, some positive and some negative. This complexity makes forecasting difficult. It also explains why experienced investors focus less on certainty and more on probability. Rather than asking what will definitely happen, they ask what could happen and how portfolios should be positioned accordingly. Global trade dynamics further complicate the picture. Modern economies are deeply interconnected. Supply chains span continents. Manufacturers depend on components from multiple countries. Consumers benefit from global production networks. Changes in trade relationships can influence cost, availability, and inflation. When supply chains function efficiently, goods move smoothly across borders. When disruptions occur, shortages and pricing pressures may emerge. Recent years have demonstrated how sensitive the global economy can be to supply constraints. Events affecting transportation, production, energy markets, or international trade can ripple throughout the system. These disruptions remind investors that economic resilience matters. Efficiency is valuable, but resilience is equally important. Governments, businesses, and investors increasingly recognize the need to balance both objectives. As a result, discussions about economic security, supply chain diversification, and strategic industries have become more prominent. All of these factors, debt, inflation, demographics, technology, trade, and monetary policy, interact in ways that shape investment outcomes. No single variable determines the future. Instead, markets reflect the combined influence of countless decisions made by governments, consumers, and investors around the world. This is why simplistic narratives often fall short. Financial markets are rarely driven by one factor alone. They are complex adaptive systems influenced by changing incentives, expectations, and information. Understanding this complexity can help investors avoid emotional decision-making. Fear and excitement are powerful emotions. Both can lead to poor choices when they dominate rational analysis. Long-term success often depends on maintaining perspective. Economic cycles come and go. Markets experience periods of optimism and pessimism. Policies change. Technologies evolve. Yet, disciplined investors remain focused on fundamentals. They evaluate risks carefully. They diversify thoughtfully. They remain adaptable. And they recognize that uncertainty is a permanent feature of investing. Looking ahead, debates surrounding debt sustainability and monetary stability are likely to remain central themes. Investors will continue monitoring government finances. Central banks will continue balancing inflation and growth objectives. Markets will continue interpreting new information. And analysts will continue debating what these developments mean for future asset performance. Some believe current concerns are overstated. Others believe structural challenges are only beginning to emerge. Both perspectives deserve consideration. Healthy debate encourages better analysis and more informed decisions. Ultimately, the most valuable takeaway is not a prediction about any specific asset or market. It is the recognition that the global financial system may be entering a period of meaningful change. Periods of change create uncertainty, but they also create opportunities for those willing to learn, adapt, and think critically. The investors who navigate these environments most successfully are often not the ones who make the boldest predictions. They are the ones who understand risk, remain flexible, and focus on long-term objectives. As we move further into this decade, questions about debt, currencies, inflation, and purchasing power will likely remain at the center of financial discussions. The answers may evolve over time, but the importance of understanding these topics is unlikely to diminish. In many ways, the story unfolding today is larger than any single market or investment strategy. It is a story about how economies adapt to changing realities, how policymakers respond to new challenges, and how investors seek to preserve and grow wealth in an uncertain world. Whether the coming years bring stronger growth, higher inflation, technological breakthroughs, policy adjustments, or some combination of all four, one thing remains clear. Knowledge is one of the most valuable assets an investor can possess. The more we understand the forces shaping the global economy, the better prepared we become to evaluate opportunities, manage risks, and make informed decisions. And perhaps that is the most important lesson of all. Financial markets will always change. Economic conditions will always evolve. New challenges will emerge while old assumptions are tested. But those who remain curious, informed, and adaptable will be better positioned to navigate whatever comes next. Thank you for watching. If you enjoyed this deep dive analysis, make sure to subscribe for more educational content on investing, economics, financial markets, and global trends. Leave your thoughts in the comments below and share how you see the future of debt, inflation, currencies, and long-term wealth preservation. Until next time, keep learning, keep questioning, and stay focused on the bigger picture.